Hello, and thank you for tuning in to today's video. I'm Gayatri from Index One, and I'm joined by Chris McKeffy and Craig Camille from BX. Welcome to Portfolio Strategies Outlook, which is a quarterly content series designed to keep you informed on market trends and evolving investment strategies. Be sure to subscribe to our email notifications so you don't miss the next video. In this session, we'll recap recent market developments, analyze strategies that have been performing well and those that haven't, and explore emerging investment approaches. We'll also highlight new strategies set to be calculated by Index One, where we're committed to supporting money managers by calculating innovative index strategies and providing timely insights into market trends and dynamics. With that, Craig, over to you.
Thank you, G. What I'd like to do is start by talking a little bit about the relationship between Index One and BX and the total value proposition of what we do and what makes us different. So, G, do you want to just tell us a little bit about not only what Index One does for the BX platform, but what it does in general?
Yeah, absolutely. So at Index One, we offer a trusted index calculation platform that delivers fast, flexible, and scalable indexing solutions. So we help build indices based on custom strategies and provide capabilities for backtesting, rebalancing, corporate actions, and distribution and reporting. We currently calculate over 200 global indices, and we've got multiple ETFs across various asset classes tracking our indices. With BX, we're really excited to foster this partnership by providing the capabilities to build custom indices for a number of money managers across different themes and different asset classes, and essentially empower investors by providing these well-performing strategies to fit into their portfolios and support their investment goals.
And just to follow up on that, you mentioned 200 global indices that you calculate, of which about 60 or 65 originated out of the BX platform. So we have a very close working relationship with you. What BX does is uses this platform of strategies, which happens to be an index and an index structure. And we deliver these strategies to financial advisors primarily in the United States, but they're available to institutions and European financial advisors as well. And if you kind of boil all this together, what we do in a combined value proposition is help make things better for CIOs and financial advisors. So we just love this slide because it kind of talks about the different things that we do as a combined entity to really help the investment department, and by helping the investment department, also improving the returns and the experience for their clients. So as we talk about the second half of the year, or the mid where we are right now, and think about the first half of the year, it'd be remiss not to take a peek at two charts. This is the first one, and we've named this the Valley of Uncertainty. And as we can all see, the S&P 500 is up roughly 5 or 6% for the year. The bulk of which of that came just in the second half of June, where we had a big lift. But what's really interesting about this is the first half of this year has really been defined by uncertainty. And there was so much uncertainty, as you can see in the first quarter, that we dropped, 15% from January through early April. But what investors need to be aware of is, like, when we were looking at this at the end of April or the beginning of April, what happened was President Trump put a pause on the tariffs. Now, we didn't know what he was going to do. In fact, looking at this chart, we all thought the stock market was going to go lower, not immediately go higher. And so that's very uncertain. The stock market historically hates uncertainty. And so the administration has caught on to that, to say, listen, we can't layer in a bunch of uncertainty to the financial markets. But investors always need to be prepared. Just because the market's down 15% doesn't necessarily mean it won't go down another 15%, which is kind of what it looked like was going to happen in April as we went into May and June. So we always need to be prepared for the ever-shifting dynamic change of the markets. If we look at the bond market, this is kind of, who would have guessed that the bond market would be so steady, but that's what we call this surprisingly steady. And it's really kind of flattish for the year. It's up, year to date, it's up about 1.5%. Not a lot of volatility in spite of all the concerns about the economy and the dollar and trading and the AGG has been a very nice safe haven to be for the first half of this year. This is a slide. It's called when and where of asset classes. So if you look at the first column, there are some just popular benchmarks. Bolded are the U.S. aggregate bond market, and also bolded is the S&P 500 ETF trusts. First quarter, you can see there's a number of indexes that were red or down. The Europe was by far the best performer, followed by MSCI ACWI minus the US, and low vol, which is conservative. But then you had all the small and mid cap and growth in the S&P 500 were all negative for the first quarter. And then you kind of roll into the second quarter, and you see a huge move at the bottom of this, where the S&P 500 was up over 11%, and technology was up 18% at the very bottom. So all the growth stuff had a huge recovery in the second quarter. And then if you say, okay, what if we combine the two of those together? You get kind of really what's worked. And what hasn't worked has been the small and the mid cap, either down or flat. But we've had all of a sudden a decent year in international and technology. So, I think one big conclusion here is that, we said at the beginning of the year that it made sense to be more diversified, and international was certainly a key part of diversifying, and Europe was a big part of that. We continue to think that looking for ways to pick up more asset classes and at the same time lower the risk of a portfolio continues to make sense. We're still waiting on the small and mid cap rally to start, but we've seen a nice first quarter for value and a nice second quarter for growth. We continue to like both those large cap categories. And then the last slide that I'm going to share, and I'll turn it over to Chris, is what we call a case for active management. So every week we see an article that says, hey, should I be active or passive, or those types of things. This is our case, with Index 1 of BX for active management. So this is a sampling of a lot of our strategies that have been around for a number of years. And in light blue are the major indexes. But, if I'm an investor looking at this slide, I'm thinking, there's a lot of strategies here that have outperformed either first half of this year or last year. I didn't have enough room to kind of show the last couple of years, but, you really start to see meaningful outperformance or meaningful alpha. And that's generated by all the work that Index 1 and BX does to find really good quant strategists from around the world that have proven time and time again that they can deliver a strategy to outperform whatever the benchmark is that they're aiming to beat. And it's not to say they're going to do it every month and every year, but we'd like to see a majority of the time that their strategy works. And this is just a great example of, hey, we really believe in active management. And it's really been an interesting year, but in spite of some things going up and down, we're seeing consistency year in and year out. So I will turn it over back to G and Chris to talk about some specific strategies.
Thanks, Greg. Chris, would you like to introduce the latest strategies that are being calculated by Index 1 and that are now onboarded onto BX?
Sure. Thanks, G. The first strategy that I'll talk about that's kind of new to the platform, I think, is an outstanding example for us of how we can leverage our network of strategists and kind of use combinations of different intellectual property to create vehicles that enable advisors to create better outcomes for their clients. So our partners at Adaptive Investments have for years published this risk hedge. And what it is, it's a combination of 4 different factors, right? It's sentiment, it's stock versus bond, it's technical, and it's volatility, to create, in essence, a risk on or risk off signal. And there's thousands of subscribers to this. And actually, you can go to adaptiveriskHedge.com and subscribe to it yourself. But what it never had was an underpinning. In other words, you were on your own in determining how you were going to leverage this signal. So what we did is we worked with a couple of our different partners to come up with, we thought, were ideal strategies to be allocated to during a risk on phase, and ones to be allocated to during a risk off phase. So during the risk on phase, the portfolio will be allocated relatively aggressively, whereas when it's risk off, it'll be significantly in cash and much more kind of conservative equity strategies. So it's a really very simple way to leverage this indicator that's never really existed before. And so this is the resulting product, and you can find the fact sheets on Index One. And it just shows the comparison of this to the S&P 500 over time. And you can see that really significantly, meaningful margins of outperformance, but much more interesting. If you come over here and look at the risk and return characteristics, standard deviation is meaningfully lower. Like that's, what is that, 20% lower? And the maximum drawdown is 23 versus 33. So your ratios are off the charts, like almost 60% higher on your Sharpe and Sortino ratios. I mean, that's really ultimately what we're trying to deliver here through the BX platform, is helping you, to deliver better risk-adjusted returns, helping your clients to get to a better place at whatever risk level they're confident with. Now, of course, you're not going to put all of your clients' assets into this portfolio, but we wanted to show you an illustration of the potential power of this. Okay, so what we did here is we took one of our BX blended portfolios that are available to advisors and put 25% of the equity allocation into the risk hedge portfolio, just to see what the difference would be. So here are the resulting statistics. So this is our 80-20 portfolio without risk hedge. This is it with risk hedge. This third column, bench 2, is just 80% the Russell 3000, 20% the AGG. And that is probably typical of what you're getting if you're using a free model available from one of the big box kind of providers. That's like average, right? So you can see both of our portfolios are far better than it, but just comparing them to each other. So you're not giving up much return versus our base model by using risk hedge. But look what you're giving up. You're giving up a meaningful amount of standard deviation, and you're getting a significantly lower maximum drawdown. So once again, you're improving your ratios. Your Sharpe ratio going from 1.1, which is great, compared to 0.73 for the cap weighted benchmark, right? You up to 1.19, and you're taking 1.16 up to 2.05 from the cap weighted benchmark by including the risk hedge in the portfolio. So what that does is, I mean, that might not seem like a huge difference, but it's certainly enough to help you take your clients whose stratify prism score or your riskalyze, your nitrogen riskalyze score, and get it back into line with where they're supposed to be if they've floated up a bit. So that's the kind of way that we would recommend using a strategy like this, but we're happy to have it, as part of our family, and happy to have it as part of the Index One offering. So one other newer strategy that I'll mention is a brand new partner to us, a Canadian technology company called boosted.ai. And they've got a model that really intrigued Craig and myself and the rest of the team. So what they're doing is, obviously, you can tell by the name of the firm, they're using machine learning to come up with their algorithms. But what they do is, in this case, this is our US equities strategy from boosted.ai. So the machine learns every year by looking at 50-something different variables, and you can see on the screen what the variables are, which ones are most important to a stock, performing better in the period ahead. In this case, it relearns annually and it reweights them monthly. And then it takes all the top 500 stocks and compares how good or bad these measures are for those stocks to all of each other. And eventually they go through a process called the Battle Royale, which I find kind of clever, to arrive at the portfolio of 25 stocks. So kind of very different thinking. And we're always on the lookout for different kinds of ideas that can help improve outcomes. And so here's a look at the fact sheet for the BX boosted US equity strategy. So 25 stocks, monthly rebalance, as mentioned. Performance versus the S&P versus the Spider over time is exceptional, with a slightly smaller standard deviation. So, just a better and different way to develop a 25 stock portfolio that is going to be very different than anything else that you're using, or really any stories that your clients have heard before. We worked really hard with these guys to come up with how to leverage their system to create a strategy that we thought would be very attractive to US advisors and their clients. That's really it on the new strategy front that I wanted to bring up. So G, I'll hand it back to you.
Thanks, Chris. And thank you both so much for your valuable insights today. And to our viewers, you can explore all the BX models mentioned in today's session on both BX's and Index One's websites. In the meantime, be sure to subscribe to Index One and BX's email newsletters to stay updated on our next Portfolio Strategies Outlook video. Thank you all for tuning in, and we look forward to seeing you next time.
Thanks all.
Thanks, everyone.
Bye.